Welcome to This Explainer. Today, we're diving right into leasing versus buying, the monthly payment trap. We're going to unravel a financial magic trick that happens every single day in showrooms all across the country. You know, dealership math. A car is absolutely one of the biggest purchases you will ever make, but the whole decision is almost always framed around one surprisingly simple number. So it's time to figure out what you're actually paying for and, well, what you might be giving up.
I want you to just let this idea sink in for a second. The cheapest car payment can quietly become the most expensive part of the deal. I mean, it sounds like a total contradiction, right? How can the cheapest thing be the most expensive? Well, as we'll see, that lowest monthly payment can actually be a hidden trapdoor leading directly to long-term wealth loss.
To really understand this, let's imagine two people walking out with the exact same shiny new car. We've got person A. Now, person A leases it. Their monthly payment is incredibly low, and in 3 years, they just swap it out for a newer model. Sounds brilliant, right? But then there's person B. They buy the vehicle with a traditional loan, and their monthly payment is, frankly, much higher. At first glance, person A looks like an absolute genius. But ask yourself, why would person B willingly pay more every single month? What do they know about the long-term math that person A is totally missing?
To see why person A's lower payment feels so incredibly tempting, we gotta look at the reality of the market right now. According to Federal Reserve data from the first quarter of 2026, the average new car loan amount financed is just massive. We're talking $42,504. Add in commercial bank rates hovering over 7%, and suddenly the traditional car payment is a really heavy burden. So when a dealer offers a lease that basically cuts that burden in half, man, it feels like a total lifeline.
But here is the absolute crucial point. The monthly payment is just the packaging. It is not the price. It's a brilliantly designed sales tool that makes a massive, heavy purchase feel super small. Think of it like a front door. Behind that door hides the actual total cost of the vehicle. We're talking depreciation, interest, and a whole variety of fees. If you fixate only on the monthly payment, you're completely ignoring what you are actually buying behind that door.
Let's be totally fair, though. For those first few years, leasing genuinely looks and feels like the smarter choice. I mean, you get lower monthly payments because, well, you aren't paying for the entire car. You have active warranty coverage, which means zero fear of those sudden massive repair bills. Plus, you get to drive a newer, safer model. It is a very comfortable, highly predictable first chapter. But here is the hidden mechanism working behind the scenes. A lease is a continuous loop, while a loan is a path with a definitive finish line. In a lease, you simply pay to use the car for a set amount of time. At the end, you give it back, you lease another one, and the whole loop just starts completely over. With a loan, sure, you pay more each month, but every single payment pushes you closer to that actual finish line, owning the car outright. Which leads us to a concept you really need to know. It's called the permanent payment cycle. Leasing keeps your monthly payment smaller, yes, but it makes that payment permanent. You are continuously funding the steepest part of a vehicle's depreciation, you know, those first 3 years, over and over again with consecutive leases. It's basically a stealthy, long-term financial trap. It's draining your wealth because you never acquire any equity. You literally never get a break from the payment. So let's dive into the fine print. Under federal law, specifically Consumer Leasing Regulation M, agreements actually have to disclose these hidden costs. These are the invisible risks that you absorb to get that low payment. We're talking excess mileage penalties if you drive too much, wear and use fees where just everyday scratches become expensive headaches, and brutal early termination fees. Breaking that contract, that can cost you thousands of dollars. That lower payment definitely comes with some serious strings attached. Let's look really closely at just one of those strings: mileage limits. Standard leases often cap you at 10 to 12,000 miles a year, but historical data from the Federal Highway Administration shows that the average driver actually logs 13,476 miles annually. Think about that. If you have a typical commute, a standard lease limit is almost guaranteed to hit your wallet with excess mileage penalties at the end of the term.
Okay, but buying isn't flawless either, and we need to look at the short-term pain it can cause. Honestly, it hurts a lot more early on. You're hit with higher initial monthly payments and rapid early depreciation. If you finance it, you might even owe more than the car is actually worth early in the loan. And eventually, you own all the risk of repairs. In fact, the Consumer Financial Protection Bureau strictly warrants that auto loans deeply affect your overall money picture, urging buyers to tread very carefully.
So what is the grand payoff here? Leasing and buying aren't simply good or evil. They aren't even competing financial products, really. They are two totally different machines solving completely different problems.
Leasing sells access. Buying builds ownership. When you lease, you are paying for convenience, flexibility, and comfort. When you buy, you carry more risk up front to gain control and the eventual freedom of payment-free driving later on.
Because of this, before you sign any contract, you absolutely must ask yourself this 5-question framework. 1. How long will I really keep the car? 2. How many miles am I actually going to drive? 3. Can I handle repair surprises after the warranty ends? 4, and you got to be really honest with yourself here, will I actually invest the monthly savings from leasing, or will I just spend it? And 5, what will I own, owe, or be forced to decide when the contract finally ends?
Question number 5 is the big one. Comparing a lease and a loan month to month is a massive mistake. The real math shows up at the end of the deal. The true cost is measured over the entire ownership cycle. When a lease ends, you have absolutely nothing, and you have to start paying all over again. But when a loan ends, you have an asset with remaining value that you can drive for free, sell, or trade in. Which brings us to a bonus insight, the secret winner. Dealerships will practically never openly advertise this to you, but think about it. If the monthly payment of buying new is too high, and the permanent payment cycle of leasing new is a trap, what's the actual secret winner here? Well, financially speaking, the secret winner is often the power of reliable used cars. Buying a slightly older, reliable vehicle completely sidesteps that steepest early depreciation. You are essentially letting someone else pay the new car smell tax. It shifts your focus from buying a feeling to buying pure transportation. Now, sure, it does require a careful mechanical inspection since you are taking on the repair risk, but the financial math is incredibly strong. And the data backs this up beautifully. Look at the Bureau of Labor Statistics data from May 2026. While new vehicles were actually up over a 12-month period, used car prices dropped by 2%. Buying used changes the game entirely. It allows you to build ownership without taking on the massive, depreciating loan burdens of brand new vehicles.
So we leave off with the most vital question you can possibly ask yourself. What is this really costing me? The dealer shows you the payment, but the real story is the cycle. Stop asking if you can afford the monthly payment and start asking what it costs when it's all over. And I'll leave you with this pretty provocative thought. If the lowest monthly payment is a hidden trap in the car market, what happens when you apply this exact same logic to your smartphone upgrades, your 0% furniture financing, or even your mortgage? We'll see you in the next explainer to find out.
Thanks for staying to the end. If this helped, we'd really appreciate a like. It helps us make more videos like this for you. Want to stay ahead? Get Market Lens by CXProWealth, AI-powered insights delivered to your inbox to help protect and grow your money. Don't miss out.